The debt situation is out of control today. We can look at that from many different levels, whether it's personal, whether it's corporate, whether you look at it on a national level as well. Each individual circumstance is going to be different throughout the world, but the general trend is way too much debt and the inability to pay it back. I wanted to show you this coming out of Australia. And what we are highlighting here is the fact that, along with many of the other central bankers, that interest rates need to go higher. It should be a cause for concern to people who are overextended because this debt, of course, is becoming very expensive. Australia's central bank chief warns damaging and corrosive high inflation. We've heard others say kind of the same thing. Inflation in Australia reached 7.8% in December of 22. That's the highest since 1990. Quote, if we don't get on top of inflation and bring it down in a timely way, the end result would be even higher interest rates and more unemployment in the future. So we should expect that interest rates would at least remain relatively high for the next little while, not just for Australia, but other countries, despite the fact that they're kind of hinting in some ways that they want to cut interest rates at some point. So we are at an inflection point at this time, and I want to see what happens in the coming days and weeks. I'll give you the updates as they come along. I wanted to show you what's been happening with mortgage rates. This is the big one, obviously, when you see how much debt people have taken out. And I'll give you the numbers actually around how much mortgage debt there actually is. But the 30-year fixed mortgage rate, Freddie Mac, by the way, Freddie Mac shouldn't really be loaning out to people the way that they do. It's kind of like, think of a backup plan, an emergency, only those who really need it. But now it's becoming the lender, not of last resort, but of, hey, why not? And you could look at it coming down to 6.32%. Again, your own mortgage rate's going to depend on where you are at your credit rating, which agency, which bank, who you're getting that debt from. But anyway, 6.32% at this point, coming down from over 7%. It is still too expensive, and some people aren't able to afford it here at this time. And we can look at companies like Zillow that have been directly impacted by rising rates. Zillow signals more pain ahead in online real estate. What is this all about? Basically, they had this algorithm that would go and they would find the homes that they believed are undervalued, that they can basically buy. They can fix it up real fast, if that at all, and then flip it. But that didn't work out, and now their company is really in trouble, at least that part of their company. Consumer debt hits a record $16.9 trillion. That's trillion, I said, as delinquencies also rise. Now, I want to make it very clear about the delinquencies. They are still low historically, but they are rising. And I'm going to show you the charts, if you stick with me here, that break it down. Like, where are we actually at historically? But it is important to see that you add $1.3 trillion of debt from a year ago. $1.3 trillion in a year. Mortgages, auto loans, credit card delinquencies all increased, though to still low levels. The rise in balances came amid aggressive rate hiking campaign by the Fed. Let's not highlight the fact that there are people that are taking on way too much debt to begin with. It's not necessarily the problem is not that the interest rates had increased. No, the problem is that there's way too much debt. Even as credit card delinquency rates tick up, the trend hasn't yet hit a worrisome level in itself, in part because the US is coming off a period of historic lows prior to 2022. But it could be a red flag, particularly when considering that younger borrowers are more likely to have student debt that is currently under a payment pause. This is big, of course. The belief is that they're never going to have to pay that back. I mean, we have to be clear about this. Student debt, people aren't paying it. And they've been saying, you don't have to worry about that. Why would you pay it back? Why are you going to pay it back when there is debt forgiveness? So I could understand what's happening here. They've seen debt moratoriums. They've seen the mortgage moratoriums. They've looked at rents, all these different things that are paused for a period of time. And they're saying, why should I? Well, we'll see what happens. How about this? Transition into delinquency 30 days plus by loan type. And you can see student loans, for instance, that has basically been squashed right down to the bottom. Nobody's needing to pay that. Auto loans, credit cards, those have ticked up. Mortgages as well, but it's at a very low level. I would remind everybody that even during, financial crisis timeframe, it wasn't truly excessive. So, a few more percent for the auto loans and the credit cards, we could start being at the same level. But it all depends on how long interest rates remain at these levels. So I'll be tracking that here on this channel. Just hit that subscribe so you can be notified of all that. Share of credit card borrowers transitioning to 90 days past due by age group. And overall, these have increased as well. So the chart goes back to the early 2000s up until now, and that has come up. We're not at the levels we were back in those days, but certainly has risen. And then you see flow into 90 plus days past due for auto loans by age group. Again, those have come up as well. Too high of interest rates that people cannot pay. I covered in a previous video just recently that the average car payment is $777. Just think about that. You add on your interest, your insurance, you add on like all the other fees that are associated with having a vehicle, and that's definitely over $1,000 a month. It's a car. It's a car. I guess you can live in your car, but that's not really supposed to be the way it goes, but here we are, 2023. Total debt balance and its composition. If you want to see the breakdown, this is it. Mortgages obviously occupying a large percentage of the total. That's something that a lot of people have got themselves into right here today, and it had been cheap for so long. However, that's changing. And this is the big concern. It's not the total dollar value necessarily, but it's how is it able to be paid back as an individual? As a corporation, you're borrowing. Well, of course, that impacts your cash flow if it starts to get to a point that's too high. The same kind of thing could happen with countries, except that the countries tend to print their way out of their messes. I wanted to give you a look at what's happening with inflation as it relates to the PPI, which is the Producer Price Index. So imagine like the raw materials, the raw commodities, these things here that make their way into the products that you and I buy at the store. And while it has come down, certainly overall, year over year, the month over month had been an increase. And if you could see that sort of in the bottom right corner there, that's just showing us that green tick upward month over month. These are still increasing. Okay, so inflation is not going away, that's for sure, at least at this time, unless there is a major recession, something that really hits the economy down hard. But generally, they are looking at this and they're saying, hey, everything's just okay. Global real policy rate is still extremely negative. So when we factor in where inflation is at today, and then you look at the interest rates should be higher than the inflation in order to squash it down, but they can't do that. They're playing this easy game, this little cat and mouse game. That's what's going on right here. It's sad to see it because inflation could have been resolved faster, but this is the way they do it. And that's all this chart is trying to show. And then really quickly here, US profits just peaked. That usually means that jobs are at risk. The widest profit margin since 1950 helped extend the US hiring boom. And then, of course, what this means to you and I is that these companies are going to hire less people, less jobs. That means slower economy potentially if they start laying people off. And companies, why would a company do this? It's because they're borrowing, okay? They are always borrowing. A company that has billions and billions of cash still borrows. And as it becomes more expensive, they cannot do what they did before. They can't hire. That's why all these tech companies that were just hiring like crazy, they suddenly turned that off, hiring freeze, and then started laying people off in certain positions. So we can certainly expect that to continue for the foreseeable future. But if they decide, hey, no way, we're going to let this interest rates, we're going to stop right here, we're going to start cutting in a few months, quantitative tightening is not going anywhere, all these things, then of course everything changes. So that's the really the world that we live in right now. I just showed you the details of where we are at as it relates to debt, interest rates, delinquencies. We have to understand it is all focused right now on what the central banks are doing. On this channel, I bring you everything you need to know related to the central banks. All you gotta do is hit that subscribe button so I can bring you the latest and greatest. All right, that's it. I'll see you tomorrow. Take care.